This is the Basu Lifestyle Show, the show about learning what it takes to build a superior you, mentally, physically, and financially. So today, Leo, what do you want to start off with?
Let's first talk about the markets, because there's a lot of confusion about the market, especially after we come off a year like we came off of last year.
Yep.
Everyone thinks it's going to continue. Last year was a very unusual year. And what happens is financial advisors, we diversify, okay, between stocks and bonds typically. And normally what happens is the stock market has you don't want all your eggs in one basket. So a typical balanced portfolio would be like 60-40, 60 equities, 40 fixed income bonds. And normally if the stock market goes down, the bonds will still stay stable. Or over the last 10 years or so, interest rates primarily have come down, so bond funds have performed quite well over that period of time.
Yes.
Last year, the U.S. U.S. government bond index, do you know what it performed last year? Minus 30%.
Wow. The
AAA rated corporate bond index dropped 26%.
So it almost mirrored the market.
So you could have had a portfolio with nothing in stocks, 100%. Like a client came to me, I want to be ultra conservative. I put 100% of their money in bond funds. They would have lost probably more than if they had an S&P 500 fund last year.
Wow.
So there was no way of being insulated. A lot of people weren't sitting on cash because there was no interest.
And everything was talking about inflation.
Everything was talking about inflation, but people, most people were fully invested because they didn't want to keep money on the sidelines, not earning any interest over the last 10 years or so.
And then with inflation, it was almost deemed useless to have the cash because it was worth less. Just cash
is trash.
Exactly. I think I read it was something like $16 trillion of net worth was lost in the United States last year.
Yeah, I think last time we got together was November, and at that time the market was down. I think we said 25% about, and now we're down what? 12 or out? 10, say?
From when? From
last year we went up about 10%, so we're still down about like 12% or so.
From the high?
Yeah,
I'm not sure exactly where we are. I know year to date we're getting off to a hell of a start.
But if you thought you were just going to wait on the sidelines, you missed out on possibly that 10%.
Yeah, and in fact, if you're a long-term investor, you're dollar cost averaging, you almost want the market to go down. Like if you have a 401k plan and you're participating in it and you're 30 years old, who cares what the market does today?
Right, because you don't need it today, you need it 30 years from now.
Exactly. So you're buying on those dips.
But at what point are you no longer a long-term investor? Is it when you have 10 years left before that horizon?
Well, I'm 61, soon to be, and I'm expected to live to age 87.
Yeah.
So I'm still a long-term investor at 61. Okay, because I still have 25 plus years ahead of me. So that's a good question. So it really depends on risk tolerance.
I get it.
So it's more of risk tolerance compared to age, really.
Yeah, you have some people that are just petrified of the market because they had a bad experience.
Yep.
And they think it's going to happen again. And then if you look too closely at your investments, it's a bad thing because the market can't always go up. Okay? Periodically, it has to correct. And so if you're going to, and most people react at the wrong time. They take their money out at the worst time. And then they jump on the hype to put their money in the best time.
When somebody at the gym tells you to do it.
Like we had a last podcast. Nobody's scared of getting in Bitcoin at 26 or whatever, 36,000. But when it drops to 14,000, everybody thinks it's going to drop lower.
Yeah, exactly. Like nobody's talking about it now.
So my thing, we're talking about the market. I think the markets are going to perform well this year. The market and the economy are separate of each other. The stock market is a forward indicator. It looks forward. Last year, with the fact that they were raising interest rates and the Fed was being aggressive in raising interest rates, it spooked the markets because if they raise them too fast, we could head into a recession. The theory is if we raise interest rates, then it's more expensive for corporations to borrow money, and as a result, corporations will stop expanding. And as a result, they'll start laying off employees. And if we can lose 1 million jobs out of the workforce, it sucks the demand out of the workforce and drives the prices down.
So you're saying that the markets are they're impacted by the news.
So I think if there's any recession or the fact that rates have gone up is already built into the market.
Right.
I think we experienced those losses last year.
Okay.
But if there's negativity in the news cycle going on at that time, then the market's also reflective of that as well, is what you're saying.
I always say there's two reasons the market moves. One's an emotional reaction, fear, confidence, uncertainty. Like for instance, when the government said they were going to shut down pre-COVID, the markets plummeted, okay, out of fear and uncertainty. So when the government came in and said we're going to pump $3 trillion into the economy with the PPP and everything else, the market shot way back up because now you have confidence.
Okay.
So the other is fundamentals, the economy. Last year it was all fundamentals that drove the markets down, bonds and stocks. the fear that we're having inflation, the fear that interest rates are going to go higher. Whenever there's change like that, defense mechanisms go up, and as a result, money managers start becoming more conservative, and they start pulling the reins in and drives the market down. And then once there's confidence and things are stable and it doesn't look like we're going to have a bloodbath, well, then the money starts coming back in. I think you're starting to see some of that right now.
So like right now, everybody's talking about layoffs, but the market already kind of priced that in.
But there's still 11 million jobs available. So the layoffs that you're hearing are primarily the big tech names. The problem, I don't know this for sure, is the fact that the jobs that are being lost are higher paid engineering type, tech type jobs. The jobs that are being offered might be in hospitality, retail, that are lesser paying jobs.
But it still indicates that the jobs are available.
Still 11 million jobs. That's why everybody wants to come to this country to work.
Yeah, it's just, so you just kind of, obviously, unless you're in your position, if you're just the average person, you just need the dollar cost average. I mean, that's
and I always go back to, you look at your favorite big Fortune 500 companies. Okay, you can say Microsoft, you can say Apple, Disney, Walmart. These companies are the same companies they were 2 years ago. The same amount of cash on the balance sheet, same amount of revenue coming in. Fundamentally, nothing has really changed at all with any of those companies except for one thing. The stock price is 20 to 60% lower. So why not buy those companies? They're not going out of business.
So they're almost staples in their sector. Like, Microsoft's not going.
Well, they have tons of cash on their balance sheet, and they're well-managed companies. And periodically, you have to expect that the stock price is going to go down, and investors come back in, or they revamp. Look at Disney; they got rid of the former chairman, of the CEO, and revamped, and now the stock's been doing fantastic.
Do you think it's good to, besides just an S&P index fund, some of the top aristocrats of dividends that are within there? Do you think it's good to buy some of them separately just to be able to get dividend income?
Yeah, you can
like have a dividend portfolio separate.
And again, it depends on the size of your portfolio. And like Verizon's a phenomenal stock, pays a great dividend.
And that's down pretty big this year.
Yeah, I think it's down like $36, as high as like 62, like 2 or 3 years ago. So
even Procter and Gamble was down a little bit. Like P&G went down a little bit, and they've been paying this increased dividends year over year.
Yeah, so I think it's a good idea. Again, it depends on your time horizon.
Yeah, it's just hard to figure out where, if you're not watching it every day, like which companies just pick.
And you shouldn't be watching it every day because you're always going to be a day late. You're always going to say, "I wish I bought yesterday," or "I wish I sold yesterday."
Yeah.
And so you buy investments that you're not worrying about that. You're buying good long-term investments that are good, sound companies that are always going to be there.
So, but I'm saying like, if you're looking at for like a dividend company, it might be good to look at some that are in the S&P index because they're obviously bigger companies that are more successful.
Exactly. Top 500 performers.
Yeah, like people already assume it's in that index. That's a good place to choose because of that.
Right, and actually the S&P 500 is considered a growth and income fund category, like asset class, because a lot of those top 500 companies are paying dividends.
Yep. Okay.
Yeah, even VOO pays. Some of those ETFs that have all 500 of the companies in them pay you a nice dividend too. It's not just contracted on the growth of the actual 500.
Correct. Yep.
But you get percentage and also dollar value.
Yeah, and what happens with mutual funds? It's different than a stock. When a mutual fund releases a dividend, it basically gives you more shares, but adjusts the share price down so that if you let's say it's a 5% dividend, the share prices come down 5%, but you have 5% more shares. So if you multiply it out the day after your dividend, the market value is the same. Okay, where a stock you get more shares.
Yeah, well, that's interesting.
Yep. Yeah.
So you might want to put together a little portfolio.
So when you look at bond funds, if you own a bond fund, you can say, "Wow, it's not performing anything. It looks like it's going down in value." That's because every single month it's reinvesting a dividend. And so it makes it look like you're paying more for the fund than what you actually are. But what's happening is every month it might be reduced by 1% because it's paying a 1% dividend.
Wow, that's an interesting piece.
Yeah.
All right, so just moving a little differently, what is a yield curve? Because you're hearing a lot about the yield curve it being inverted.
Yeah, so normally during an inflationary period of time, you'll have a shorter term yield. Like the 2-year bond is yielding more than the 30-year bond right now. So it's an inverted yield. Okay. Normally what would happen, the 30-year bond would be producing a higher yield.
You should get more money for something over 30 years than 2 years.
Correct, because the risk is spread out over a longer period of time.
Yep.
So today, like I said, a 2-year bond is yielding higher than a 5-year bond.
Yep.
And so and that's what the shorter term instruments are the more treasuries and so forth that are predicating what the yields are going to be for CDs, treasuries, any other type of fixed income.
Okay. So now, since it's inverted, now is a good time to be buying them if you want to stay safe.
Yeah. So again, so you're going out. The most you can go is 2-year bond.
Yep.
2-year treasury right now is I think it's like 4.2 or something like that. So yeah, same thing with municipal bonds right now. You can get like a 4% municipal bond.
Yeah, I mean the 6-month treasury is like 4 something too.
Yeah, but it's 6 months.
Yeah, you're only getting.
Okay, and I think the rates are going to continue to slowly go up for probably part of this year, probably 3/4 of the year, and then stabilize. The thing is it's all about inflation, and so what the government's telling us, yeah, inflation's getting under control. Well, it's still up 9% from a year ago. It's just not going up any higher.
Not raising.
Yeah.
Okay,
under
but
control.
it's not going down because
It's slowing.
when you think about it, I don't think a lot of these prices are ever going to come down. As long as they don't want to curtail the price of energy, like diesel fuel is $5 a gallon.
Yeah.
So that farmer's paying $5 a gallon for their tractors, and then they have to ship those eggs or whatever they are someplace around the country or the world, and then the buildings that they're being stored in are being heated and so forth, and all that has to get passed on to the end user. And not only that, a lot of businesses, to entice people to get off unemployment, they had to raise the minimum wage.
Yep.
So they went from like $6 to $16 an hour. Well, they have to pass that excess on to the end user.
Yeah.
So these prices are here to stay. I don't think they're going to go down. You might have a small adjustment down, but as long as they don't want to tackle the cost of energy, these prices are here to stay. And it's not like you pay somebody $16 an hour, you lay them off, you could hire them back for $12 an hour because there's still 11 million people looking for jobs.
Yeah, they're not moving down. Nobody wants to make that anymore.
The pay is not going to go down, and it's only going to escalate. They've already said the next 2 or 3 years.
So what it's doing is throwing seniors on fixed income into poverty.
Yeah.
Yeah, they have to refinance their house or do something.
Or even their investment portfolio. They lost 5 years of growth last year. If they were in a 60-40 portfolio, they lost over 20%. So that's it could take them 5 years to gain that money back.
So what's their best option, kind of, to stay and ride the wave?
Well, the best option, I think, is working as late as possible.
Yeah.
I think a lot of retirees are starting to realize they can't afford to retire and they're going back. And a lot of these jobs that are available are great retiree jobs. Yeah, and
like
working at
greeters.
Greeters, convenience store, things of that sort.
Hostess, anything that's going to not require gratuitous
physical work. Yep.
Yeah.
Yeah, it's more or less just interactive customer service, so to speak.
Exactly. But they don't really have a choice. The choice is, if they don't have enough money invested, they have to take more risk.
Yeah, and then the issue is if it goes down more, then they just lose even more.
That's
of their
correct.
money.
Yeah, you don't want to be.
That's why you diversify.
65, 66, 67, have to sell your house that's paid off just to make ends meet for the next 10, 20 years.
I've had clients that refinance their homes to send their kids to colleges. So here they are. They finally got the house paid off, and they don't have any money saved to send their kids to college, and then they take a mortgage out, and they're getting ready to retire.
That's why when you told me open an investment account for your brand new baby.
What I wanted to ask you was, what is the difference between a treasury and a CD?
Okay, so treasury is backed by federal government, banks backed by, CDs backed by a bank. Okay, CD, what is that? That's a good question. A CD is a fixed. A bond is fixed right too. The difference is the value of a bond could fluctuate while you own it. Okay, depending on if interest rates are going up or down. But then when it matures, you're getting the fair market value of the bond. CD is where you put $10,000 in, it's always worth $10,000 plus the interest that accumulates.
Does that compound? So each year it's going to compound. If
Depends
it's a 5 year.
What's
will
that?
They all the CD. So say you buy the $10,000.
Yeah,
CD.
so it depends. If it's compounded monthly, they take the annual yield and divide it by.
So that's something you want to look into to make sure it's like a compounding CD or something.
Correct.
Okay.
Yeah.
Yeah, because if you're leaving it in there and just getting the straight 5 and it's not growing, then you can do that somewhere else.
So a CD is a CD going to be better than a treasury then long term because at least it's going to compound if
I
they're
think
a
so.
Similar rate?
Yeah, I think so.
Okay, so if it's more than
so.
I guess a year.
And you know what's interesting? In the last 10 years, nobody mentioned the word CDs to me.
No,
Because there was no reason to put money in a CD.
Yeah.
And that, like fixed annuities right now, if you were older, you don't want to take any risk, you get a 7-year rate guarantee for 5.4%.
So what is that if you want to explain it for some
Okay,
people?
so fixed annuity is sort of like a CD, but it's backed by an insurance company as opposed to a bank.
Okay.
And annuities grow tax deferred. Okay, so there's no income tax until you start taking that money back out. And so then you have to look at the stability of the underlying company, the insurance company that's issuing that fixed annuity. And then certain states, like New Jersey, has an insurance it's like a reinsurance fund. So if that insurance company would go belly up, you're insured. I believe it's up to like $300,000.
Okay.
So
But you never want to invest in a company that goes belly up, because by the time you get your money back, who knows how long it could be.
And are you even getting your full money
Yeah,
back?
and very rarely a company will just go bankrupt. Normally they'll be consumed by another, like a bigger company.
Where do you usually buy those?
Fixed annuities
Yeah.
through a financial advisor.
So you have to go through a financial
Yeah.
advisor.
But are you still?
But it wouldn't be appropriate for somebody your age.
Yeah. So
No, I was
that's
just-
the question, 'cause
yeah.
you recommend that for somebody who's in their twilight.
Yeah, like I just put a couple people. One woman is like 74, doesn't need this money, just wants to put it someplace safe.
Yeah.
Tired of keeping it in a bank account, not earning anything.
So you're giving them your money for the promise of getting money on the regular.
You're getting guaranteed interest.
Yeah.
Yeah, with no risk to your principal.
Yeah, no, that's good.
So
for,
they're,
like you
what are
said.
they doing with your money then? They're lending it out to other people? How are they guaranteeing the
Insurance companies are heavily regulated, where they have to have a certain amount of reserves.
Okay.
Okay. And those reserves have to be very conservatively invested, like in government bonds and so forth. They can't be buying crypto with their
Right.
reserve funds.
So
So
it's like
for an
utility
insurance company
bonds.
to maintain an A+ rating by AM Best, they have to have a certain level of reserves. If they don't have those reserves, then it goes down to like an A rating, A-, triple B, and so forth.
But if you're buying a AAA rated.
But you know what you're buying,
Yeah,
because
exactly.
you know what insurance
Well, you
company
do.
you're buying into.
Okay.
do your due diligence?
Yeah.
Do you said municipal bonds earlier, but do you like or dislike utility bonds?
Again, they were never
Really a thing, right?
They were never a thing, so
Yeah.
I don't really know much
Like,
about
it's
utility
been,
bonds.
It's been stuff that I've been hearing a lot about like the past couple of weeks. That's why I was kind of curious.
Yeah, it's like these.
I understand
It's
what
like
they
these
are,
I
I just
bonds.
never-
Have you heard of I
Yeah.
bonds? And so what happened? They're misleading though, because you'll see 9% I bond, but what happens? That interest is recalculated every 6 months based on what current interest is.
Yeah.
You can only put up to like $10,000.
Yeah, I bought one last year because it was 9% for the
Well, if you
first
did it-
6.
yeah.
And then the next, they already knew what it was going to be. It was going to be 7.2, so you're getting.
Whatever, and then
8%.
another 6 months it will reset again.
Yeah.
Yeah, I think I did the same thing. It was 9 for me. It was like 6.2. Then it was like 4.1.
Yeah. So inflation goes down to 1, it's going to go down to 1.
Yeah, but you only have to leave it in a year than 3 months, right, or something like that. 3
I
months.
thought
There
that
was
you.
like a
I thought
3
you have
month.
to keep it longer
Yeah,
than
I
that.
thought it was a 16
Nah,
month. 16
I'm
months.
pretty sure it was
Was it
3 or 4
3
after, but
Yeah.
we'll dig into
Yeah, I
it.
thought it was longer than that. I thought you had to be in for like 5 years, and you're not allowed to take any money out after during the first 12 months or something like that.
Yeah, you can't take it out
Yeah,
the
so
first
it's nothing
12,
for the year.
but 3 months later, you would just lose that 3 months of interest.
Correct. Correct.
Yeah.
Correct.
Okay.
But you retain your first year of 9. So
But you know, it's interesting. All these types of investments are being discussed today.
Yeah, that's
Because,
why we wanted to ask
because
you.
we've never had an interest rate
everybody's talking about
environment
them now.
like this
Yeah.
for many, many years.
Yeah, since when was the last time? Maybe the.
Yeah, I mean, it stinks if you're on the other side of the coin where you're borrowing money to buy a house.
Yep.
Yeah.
But if you're on the if you're looking for a secure investment, it's a great time
Yeah, to
to
buy.
invest.
Now you think they're gonna stay for?
I think
Short
rates
time.
are, I remember if like my first mortgage was 11.2%, and that was a special mortgage for first time homeowners, and I'm high fiving everybody. I'm only paying 11.2%, and so you never really thought. And then I remember mortgage rates went down to like 8%, and so wow, they're never going to go lower than 8%, and the government needs more tools in their tool bag. What they did, they brought interest rates down to 0. So if we have a softening economy, there's no place they can go. You can't lower rates anymore to stimulate the economy. So I think it's healthy that rates have come up, as long as they don't go up too high.
Yeah.
Because again, it's an adjustment. Wages are going up to help compensate for the higher interest rates on loans. But then again, if you're a fixed income and you don't want to take any risk, you could benefit from that as well.
Yeah. Yeah. So they're probably healthy somewhere between, I guess, like 3 and probably 8 or 9 is kind of like a healthy number. When they go lower or higher, it's because there's issues.
Yeah, so they always try to keep interest rates within 2% of inflation.
Okay.
So, and inflation, a healthy inflation rate's around 3%.
Around 2%. So what are they at right now? 7 or 8 for a mortgage right now? So
It's
that
6 something.
6.
Close to 7.
So we're like 8, 9 then for inflation still.
Yeah.
Yeah.
Yeah, because again, fuel prices aren't coming down. I mean, they might temporarily
They
come down.
Peter, like
Yeah,
you can go 5 miles and see it for 30 cents more, or you can go the other way and see it for 30
and a lot
cents
of
less,
it
but
was
it's
driven
always
down
the
by
same.
because they drove them down with releasing all the reserves.
True. Now, who really is, so I watch a lot of different YouTube videos trying to understand the economy and how everything actually works. And certain things are trying to say now that the Fed chases the 10-year Treasury instead of the Fed is in control and the 10-year Treasury is behind that. Do you kind of know anything about that, really?
No, but I just know this time around, I think the Fed was behind the eight ball. They should have gotten out when they said inflation was transitory a year earlier when it wasn't transitory. I would like to believe that they knew it was here to stay because they threw trillions of dollars out of the economy. So, you know,
how would you be able to recoup that money if you knew that you couldn't control how to get it back?
Just the definition of inflation is when you have too much cash chasing too few goods. When you throw trillions of dollars at an economy, guess what? Everybody has cash.
Yeah.
And so
I mean, that's what you saw during COVID too. People were getting those not even PPP. We were just getting stimulus checks.
Yeah.
And then you were seeing everybody dumping it into, they were either buying shit they didn't need or they were investing it. And so it was, once the market took that dip and people started throwing all that free cash into it, you started to see it climb.
Yeah, absolutely.
And they gave you that money. They printed that money for you.
And now they're pushing those employee retention credits. It's every other advertisements for employee retention. There was so much money printed that they can't even give it all away.
Yeah, they just can't figure it out.
No.
Because like now too with that, the 10-year Treasury, which is what mortgages basically go off of, is starting to go down a little bit. So that's why people are trying to say that the Fed chases them. That's why the Fed's slowing down.
Well, I think again the Fed should have, if they would have gotten out ahead of this.
Yeah.
When they said inflation was transitory, then they could have done much smaller moves that would have not shocked the markets. But instead, they waited till last January, a year ago, when it was already too late and inflation was rampant. And then they said, you know, the way they approached it was, we're going to be really aggressive and raising interest rates. So it scared everybody. So getting back to you is the Fed ahead of the, what was your
like the 10-year Treasury, basically, like who's actually running the show?
Okay, so bonds are based on supply and demand.
Yeah.
So the more interest there is, the higher the interest rate's going to be.
Yeah.
The more demand there is, the higher the interest rate's going to be.
Who creates the demand?
Investors.
Okay.
So it's kind of like
and then
a
the
game
government has
almost,
the government has auctions too. They auction off treasury bonds, and so and again, it depends on how healthy that auction is. Depends on what the yields end up being.
Yeah, it's just, there's just so much information out there and trying to differentiate it and then just figure out where you should be putting money and staying safe, but also trying to make money.
It all depends on time horizon and liquidity needs. Okay, and risk tolerance. Like myself, I have an appetite for a lot of risk. I would never invest my clients' monies the way I invest my own money because, you know, I understand risk. My average client does not understand risk. They're not afraid of risk again when the markets are high, but all of a sudden when the markets are down, they're afraid of risk.
That's what they have you for, though, right?
Correct. Yeah. So every financial advisor will guide their client and provide education and so forth. So
I think last time we met was October, and you had said as long as you have your emergency slush fund of cash on hand for at least 6 months of whatever your bills or needs are, and that's not money that you need to live today on, but you have it in case you need it, then investing after that should be, like you said, time horizon.
Right, like at your age, for your
now.
retirement money, you should be as aggressive. You should be 100% equities.
Because it's going to come back no matter.
It's going to come back, and plus you're adding to it.
Well, you said it was cyclical too. So as it comes back, we don't need it. Within the next 30 years, it's going to come back up. It'll go down again, but it keeps climbing to new heights after each.
You know, it's funny because now I'm on that end of the spectrum, like over 59 and a half. And I've been in this business for 40 years, and now the investments that I started many years ago are worth a lot of money now.
Yeah,
you know, it's
just because you held the course.
Held them, the dividends got reinvested over the years and so forth, and they appreciate over the years. So I look at there's 3 stages that people need money. One is, like you said, emergency fund if you're going to buy a house, getting engaged or whatever. You need a liquid slush fund, and then the second is midterm, buying either a second home or educating your children, college expenses and so forth. So you have to save for your midterm goals, and then you have your long term, which is retirement. Mm-hmm. And really, what you want to do is be addressing all 3 of those needs all the time. That's why 401k is so good, because it's effortless. It comes out from your paycheck.
Just do it. Don't think about it.
A lot of times your employer is going to match a part of your contribution.
Well, that's the nice part. It's automatic, no thought. It's going out.
Yep.
It's money you're never going to have in your pockets. You're never going to miss it.
Correct.
You dictate what you put into it, right? So if you know that you can't live off of losing 10% of your income, don't put 10% of your paycheck and put in 5. Take the employer match or whatever it is and call it a day.
So what I tell people is try to 10.
Right, try to 10.
Okay, and see how it feels. You can always go down.
Right.
But people don't want to give up too much of their income, so try to 10 first. And usually once they do it, they keep it there.
Yeah, you don't even realize it after a while, and especially if you're not
It's
looking at your statement.
pre-tax.
Yeah, try not
Like
to
I
look at
said,
the
you
statement
can't
on
miss
top
it
of
if it never hit your pocket.
Correct.
You know?
And it's pre-tax too. So,
Right.
so
How much should you be concerned though? So say you're investing into a 401k or like a 403b plan with the amount of money that some of the advisors take, like the expense
Yeah,
ratio.
so-
like I have one now that just to buy into an S&P index fund, it's 1.5,
that's ridiculous.
and that's the only option we have.
So that's probably with an annuity?
It's fuck, I don't care. It's AXA Equitables.
Yeah, it's an,
So
it's an
okay,
annuity.
yeah. So it's
And there's a
1.5,
representative.
That's the lowest.
Yeah,
exactly.
there's a representative involved, and,
Yeah.
and so as a result, they're probably most likely being compensated for that.
Yeah.
And there's nothing you can do about it
It's
because
the only
you have
company that they offer
you have
us.
to deal. Now, expenses really. I used to get people. I don't want to buy that fund because the expense is too high. Well, you can go to a Vanguard fund that has a very low expense ratio, but maybe say like their Windsor fund, which is like a very conservative, like balanced type fund, and where you can pay maybe a load, say 3% to go into Growth Fund of America. Different type of fund. It's more aggressive. You can get a better return on the Growth Fund of America because more aggressive.
Yeah.
Because you probably didn't understand what the objective of that Windsor fund was.
Yeah.
And you're looking at the expense and not what the objective.
Well, if
of
you're
the
just
fund is.
looking-
Not growth over conservative.
Index fund like an S&P, something that mirrors
But
that.
S&P should be dirt cheap.
That's the
So
cheapest fund
it's
they
the
have.
cost
Yeah.
of the insurance company
Yeah.
that's charging that excess money.
And the
So-
person that clicks the button buy when you say I want to put money into it.
Because an index fund is an index.
That's what I'm saying. It's
Yeah.
because Vanguard has the same one for 0.05,
Yeah.
but that one's
Yeah,
1.5.
exactly.
So should you just be investing into something on your own outside of your work one, I guess, basically? Like open your own, some kind of retirement account?
Yeah.
That's tax deferred?
If you can, it depends
Yeah.
on if you have any room, because if you're maxing out, and you're better off maxing out the pre-tax plan that you have at work.
Even with a higher expense ratio, you think so?
Yeah, absolutely. Don't worry about expense
Yeah.
ratio.
Okay. That's interesting because that's one of the things that's
When I
been
got into this
bothering me.
business, we used to pay, it used to be 8.5% upfront sales charges. So you pay 8.5%, and then
There was no fine print.
yeah, and the internal expenses were ridiculous, and the financial advisor was the only one making money.
Yeah, no, it's basically like it's crazy because it's a question that I work with 200 and some people and nobody knew what the expense ratio was. People who've been investing into it for 30
Well,
years,
that's because you're the most analytical.
which is good and bad at times, I think. But that made me say maybe I should just be buying it after
Nah,
tax
you can't.
anyway.
You can't. Well, it's easier to have the money come right out of your paycheck and get invested on a pre-tax basis. The only disadvantage of being pre-tax is sometimes you're going to pay the tax. But then you're getting compounded growth and all that money that
Yeah, it
you
almost
normally would be paying.
dissipates. You're not going to lose money on it if you're continuing the growth. Like you'll never notice that 1.5 if it's in there for 30 fucking years.
Yeah, not only that, when you go to retire, it's not like you're going to cash out the whole account on day one and pay your tax and move on. You're going to take an income stream and pay the tax over a period of time.
Well, what if you plan on making more money after you retire?
Nothing wrong with that. Then you're open. You have your own business and you set up your own pension plan. And
You figure it out from there.
exactly.
Yeah, because that's just one of
I would
those
say
things
as
that really
long as
hurt
you're
that.
adding, as long as you're always saving,
So just put it somewhere.
just put it somewhere.
Okay. Now, I guess there's no point in asking. What is the most you can put? Do you know off the top of your head? Like
In a 403B.
Yeah. I think it's like 17 or 21 or
It's
something.
like 17.5 or something like that, and then there's
Yeah.
a catch up between age 50 and 50. I guess age 50 and 60. There's a catch up provision that you can put up to like another 5 to 10% in.
Yeah, I'm just thinking if I should open something separately and do like the same similar amount. At
Well,
least
what you
half
do
of
have to
that
see, yeah, because you're capped on how much you can put away for your retirement.
there. Yeah.
Although you have a business here, you could set up a what's a SEP.
I have one of those through real estate for when I do the sales and all that. I do a SEP, so that's yeah.
So you can do something like that.
Okay, so at least it is separate from there, getting a little bit different
Right.
going on. Yeah, because I'm sorry, that just kills me.
So my question was, I'm anal about always making sure that my Roth is filled before I start putting. I already have auto investments set up, so I don't have to worry about that money that goes out. But before I start putting more money into my investments, I max my Roth out.
Mhm.
So it's now February. My Roth is maxed out for the year.
Yep.
Do I open a traditional on top of that? Like, you can have both that run intermediately, right? Or,
Yeah. But you're limited on how much you could put away.
Yeah, it's like 6,500.
Yeah. So you're
in each of them.
correct.
So does it? But is it prudent for? Should I be just saying, okay, the Roth's maxed, move on to the next thing, put that extra money into just straight investments, or do I open the traditional and have two avenues for retirement when I still have compounded growth through my auto investments in my portfolio?
Yeah. Again, is the more you put away in
Right.
different places, the more secure you're going to be.
Okay.
Also, as long as you have money, as long as you're investing money.
Yeah,
Okay.
right.
So then it depends on what part of your life that you're investing the money for.
I'm investing it for his retirement.
Yeah.
Like literally, so that.
So you could do that.
Whenever
So you don't
we-
spend it.
Yeah.
Right. Yeah. Because So we don't.
Hey, before you,
You
go,
don't wanna
it's,
pour it
it's
down.
so weird. It's like I hear like somebody asked me how old I am. I'm like 60. I'll be 60. Those words seem strange coming out of my mouth because time goes by like that.
And you didn't, like, I'm pretty sure even you pictured 60 as so much older. Like, every time
Yeah.
you hit an age, you always picture.
Well, you know, it's funny. I thought I remember when I was younger. I said, okay, 45, I'm going to retire. And then 45 comes around. I actually tried retiring
You'd be
for a
bored as
couple
shit,
years.
yeah.
I was bored as shit,
You'd
and
be
I
so
went back to
fucking
work. And I said, okay, 50, I'm going to retire. 55, it's I enjoy doing what I'm doing. I don't really consider it work. But the longer you work, just the more. I mean, in your situation, you get a pension, which is great. But the longer you work, just the more secure your later life is.
It's just a matter of, I think, finding something you actually want to do every
Correct.
day. That's helpful.
Correct.
Because if you hate
That
whatever
is
you
helpful.
do, that's
Yep.
why you're looking forward to retirement. If you hate what you do.
That's correct. I retire a lot of corporate employees, and they're just counting down the clock to that 30th year that they could pull the trigger.
Yeah, that's
Because they
that's
hate
where
their
it's
jobs.
not a good
Yeah.
way of life. Back to the Roth.
Yes.
What is a good idea if you can't put into a Roth because your income's too high?
Okay, so just a mutual fund. You can go to like Vanguard or Fidelity or something like that and get like their growth fund. Again, the younger you are, the word growth means and equity means stock.
Okay.
Okay, total return balance means like 60-40 balance type fund. Income is bonds. Growth in income would be like preferred stocks that produce dividends, and maybe some bonds in there. So you at your age you want the word growth.
So do you want growth, or what's the difference between picking a growth fund and just picking like an S&P index fund?
Well, you can look at to see what kind of investments are in that growth fund
Okay.
versus the S&P. So if you are a believer of more tech-oriented funds, then you can pick a growth fund that's more tech-oriented.
Yeah, like
So
ARC's got just a straight tech fund, and that's all they.
Well, you can get sector funds. Sector
Yeah.
funds will invest like just in utilities or just telecommunications or technology, computers, information services.
So should you kind of separate some of that, like some in an S&P index fund, some in like a growth fund, or just all?
Yeah, I always suggest having more than one fund
Okay.
because you never know which one's going to do better. But the S&P, most mutual funds are trying to beat the S&P.
And most
percentage
don't,
of the
though.
market
And most
too,
don't.
right?
And most don't.
Yeah.
But if you get like Fidelity and Vanguard, they have great money managers, and they're very inexpensive to buy.
Is there an amount of money? Are they insured up to so much, or how does that work?
They're not insured. A mutual fund, you own the stocks that are in that portfolio.
Okay.
Okay, so I don't think a mutual fund can go bankrupt.
Yeah, like that was just my thought.
Every
Like, if
every
you had 10
stock in
million
that
Vanguard-
portfolio would have to go bankrupt
So if you had 10 million in Vanguard, you shouldn't, like, unless all the stocks go to zero, you're good. Like,
because the money's not
But they
invested.
won't let. So you can have 10 million in there and know that it will never go to zero because they're constantly switching out the losers.
Well, every stock in that
Right.
portfolio would have to go to zero.
so yeah, I'm just saying
But
you
like,
wouldn't have
as
to worry
one
about
starts to
fraud or the
dump-
company failing.
The
Realistically.
money's not invested in the company.
Okay.
Yeah.
Okay, just like you ever hear of variable annuities or variable life insurance?
A little, yeah.
Okay, the word variable means it's tied to the market.
Okay.
And so the investment is separate of the insurance company. So if the insurance company were to go bankrupt, the money's in a separate account. The money's in the investments. A fixed annuity is an asset of the insurance company. It could go into like receivership and you could lose control of that money for a period of time. But a variable annuity, if the company went under, the money's not invested in the insurance company.
But again, the annuities, you're just being guaranteed a income stream.
Well, that's a whole other subject because there's all different types of annuities
Okay.
with all types of benefits attached to them and so forth, and that's a session for itself.
Yeah, we'll do that for the next one. No, because I mean, I know that it's not on my event horizon anytime soon.
No,
but
it
I'd like
should
to
be.
know what they are, though.
Yeah, it's.
I might just do it just to be, just because it kind of intrigues
Yeah,
me.
the interesting thing that I've heard about is a whole life policy that you can borrow from, so you're still
Yeah,
getting-
same thing with universal or variable.
Okay, it's a
Yeah.
similar thing.
And because you're paying the interest back to yourself.
Yeah,
Um,
but that's not really interesting. You don't think till you're older?
well, again, it's just another
Yeah, no.
place that
just-
you're socking money
Okay.
aside. So
Yeah, it depends on what you're going to use it for.
and the advantage to that is you can pay in. Like I have one that I paid into years ago, and it's tied to the stock market, and it just keeps going up and up and up over time because the dividends are being. I don't even put any more money into it, and it just continues to grow. So the advantage of that is the fact that you can have it for your whole life.
And technically, you can borrow against it and just pay yourself.
And you can borrow
back the
against it,
interest,
yeah.
and you still earn a dividend.
Correct.
That's interesting.
Correct.
So, who do you have to talk to? Who should you talk to if you're interested?
Financial
in something like
advisor.
that? So that's definitely a financial advisor. That's
Yeah.
not a just go online and try to.
Correct.
That sounds
And,
complicated.
Yeah.
and then you have to look at the financial advisor. Like, if the financial advisor is really a life insurance agent, their persuasion is going to be to sell that life insurance policy because that life insurance policy is paying their income for the next month. Okay, and a lot of times, life insurance agents aren't as knowledgeable about investing. And some financial advisors, like a Merrill Lynch, Morgan Stanley, one of those guys, they're not as knowledgeable about life insurance either.
Yeah.
Right, it's both ways.
So you can get but if you get a person that's like a representative, say of like a New York Life or Prudential or something like that, they're not going to be as objective because they're going to represent just the product
They
that
wanna
they
represent that
have to
product.
represent.
And then should you ask? How would you ask them to know kind of what your
And
expenses
actually,
would be?
what would probably be most appropriate, like for someone your age, is what's called a variable universal.
Okay.
Because the amount of money that you put in is variable. So if you're having a good year and you want to put some extra money into it, you put some extra money into it. If you have a leaner year, you want to put less, you can put less in it. And then you could pick the investments. So if you went in the S&P 500, and again, your dollar cost averaging because you're paying a premium. And the same thing, it works the same way as whole life insurance, that you can borrow that money out. Difference is you don't have dividends that are being reinvested into the policy. But there's a lot more flexibility.
Okay. So there's a lot of.
Like I have a variable life policy.
Okay. Is there any other questions you want to add in?
No, I think that's interesting. I want to talk about that in the next one. I'll get some good ones built up for that. That's cool.
Yeah, I really like because I was reading a book called I think it's called Infinite Income or Infinite whatever for whole life policies. But some of the people who come to our job, there's like only certain companies who can come.
We have some company
And-
gyms too.
Yeah,
Yeah,
and he's
and-
the girl was like, oh well, and I was like, have you ever heard of whole life policy? She was like, oh, we don't do that, but this is what we have, and I'm like, okay, thanks, I'm good.
Well, you always have to look at how the person's being compensated.
Can you? How do you ask that? Can you just say,
Well,
how are you being
okay,
compensated?
so it's
Am I paying you, or are you paying by a company?
yeah. I think if you go to an independent financial advisor,
yeah,
okay, an independent financial advisor is independent. They're going to go into the marketplace and find out what's most appropriate for you. I think the more established the financial advisor is, then probably the more objective they're going to be because they're financially stable. I know in my younger years I probably should
Their
have.
rent or mortgage this month isn't predicated on you signing this piece of paper.
yeah.
Right
It's
now.
it's the same thing in real estate.
And
There's
it's-
agents
it's-
will push you to buying a house.
Correct,
you know,
because it's a
yeah.
commission-driven industry.
Yeah,
And the younger guy, he's either taking a draw account and they have to produce, otherwise they're out of business or they're in debt.
yeah,
And I remember my younger days, I would do anything I could do to try to make a sale because I had to feed my family.
yeah.
And so as a result, sometimes you're not as objective. You're worrying about yourself ahead
put
of
your
ahead of the
interests.
client. That's why the last couple of years, FINRA and the SEC came out with all these best interest rules. I don't know if you ever heard of these best interest.
No.
So you have to, in essence, you have to put the
Put in
customer's
your
best interest
needs.
ahead of the financial advisor.
But
What
that's
are-
only if you're like a financial advisor with a fiduciary duty, not a sales
Correct.
rep representing a company.
That's correct. That is correct.
Not if you're not
That's-
reporting to them,
that-
they
that
can't
is-
dictate.
So
to
should you just ask, do you have a fiduciary responsibility? Is that an important question to ask?
Yeah, you can say, "Are you a fiduciary?" Now they could be a fiduciary where they're really not a fiduciary. In other words, they're a registered investment advisor under a larger company's umbrella, more or less. So,
Okay.
in essence, because they're representing a larger company, they're a fiduciary because they fall under their registration.
So it's more of a due diligence on your part, and ask the questions. If you don't like the answer, talk to somebody else.
Yeah, and also when you're meeting with a financial advisor, you have to be comfortable with them. They're handling your money. So
Yeah.
so if you feel like you're being persuaded, or you don't feel like they're really acting in your best interest, then interview other financial advisors.
Okay, makes sense to me.
Yeah, my whole thing is if somebody comes to try to do a hard sale for me,
Yeah, your defense mechanism.
yeah, I'm just I don't need this today.
Yep.
I'm just shopping around. Thanks for, but I know I'm not going to call you back.
You know, it's interesting. I over the years, I developed like a really good clientele and a successful business, and I would tell them, look, if you want, go interview some other financial advisors, and then come back to me. Most of the time, they say, no, I want to use you because I'm offering them to go speak to someone else.
Yeah.
I mean, that's just being an open book.
Well, and not only that, a good financial advisor is not looking short term. They're looking long term. The relationships are building long term.
Yeah, and once you have a bad year, they're going to stay with you because they trust you compared to once you have a bad year, all right, give me my money. And then you have to deal with getting rid of them and getting somebody new.
Exactly.
So that makes sense.
So, you do right by, it's like your
It's
business.
quality over
It's like your
quantity.
business. You do right by the customer. They're
Our
going to tell more
business.
customers. Our business.
Yeah, I mean, it's quality over quantity, and I think that goes for almost anything that you do. It's you get back what you put into it. So if I'm just here pushing shit on the table, hoping that you take one of those pieces of shit home with you, you're never going to be happy. But if I'm sitting here breaking it down for you or showing you that I also give a shit, I have an added interest in you doing well, not just because it's financially good for me, but because I give a shit about what I do, I'll do whatever you tell me to do.
I know in Brigantine, when he doesn't show up there, people are always looking for him because he's the face of the gym. They come in the morning. I used to, when he wasn't there, I was, oh man, where is he? This is before I even knew him. And because he's the face of the gym, so people like coming in the morning and seeing his handsome face, and it's scary in the morning, but
Grows on you. Slowly grows on
It
you.
grows on you. Like
So
a fungus.
how could people get in touch with you if they wanted to talk to you about anything we talked about?
I have an 800 number,
Okay.
800-644-4204. Websites, www.invest2retire.com. That's the number 2
Okay.
retire.com.
We'll add it in the bottom too. Like the video, subscribe to the channel. Stay tuned.
Let's go, guys.